Hello and welcome to Charting the Markets on Wednesday, the 26th of April 2023. Let's begin by having a look at today's economic calendar, and at 1:30 p.m. we've got US durable goods orders out for March, and we expect those to rise by 0.9% overall and to fall by 0.3% excluding transportation orders. And at 3:30 p.m. we've got the US EIA crude oil inventories out for the week ending the 21st of April. Now, overnight we had equity markets in the US fall quite sharply on the back of First Republic Bank. Its share price basically sliding by up to 50% at one stage on news that its deposits fell by over $100 billion in the first quarter of this year, and it also announcing staff cuts of around 20 to 25%. And this then led to contagion fears with regards to the banking sector, and the US banking sector selling off quite sharply. The European session so far also selling off, but not to the same degree. But better than expected earnings from the likes of Alphabet, Microsoft and Visa yesterday helped US equity markets stabilize a bit, and we'll have to see whether that will continue today with the likes of Boeing, PayPal and Meta later out today also reporting on their first quarter earnings. Now, if you look at the FTSE 100 daily chart, you can see here that we have come off since the beginning of this week and have had so far 3 days of lower prices, but you can see that we still more or less trade in very low volatility, short trading ranges over the day. So far this morning we've slid to 7,840 on this daily financial bet, just marginally below this support area which we saw between the mid and late February lows around 7,850, but not much really going on here ahead of those earnings out later on today in the US. So we'll have to see whether these declining prices we're seeing at the moment on the FTSE 100 is part of a topping out pattern, or whether it's just a sideways consolidation with a slightly negative bias, which is quite normal after the sort of advance we've seen over the last few weeks in the price of the FTSE 100. So I wouldn't read too much into it unless we were to see a strong, sharp candle to the downside emerge, like we saw, for example, at the beginning of March with the banking crisis. As you can see here, we had some very sharp declines with regards to the FTSE 100. But here we haven't seen that yet, despite the worries to do with First Republic Bank in the US. So we clearly see that for the time being, at least, there doesn't seem to be any contagion with regards to European markets. Now, moving on to those European markets, we have got here the DAX 40 contract, the German contract here, the German index, and we can see here that what we did earlier today is to retest the low from last week around 15,703, dipped marginally below there, but then recovered again. And we did so on a stronger than expected German GfK consumer climate on the climate indicator, and basically that jumped to a 13-month high and rose for 7 straight months to minus 25.7 heading into May, and that is the highest reading of this indicator since April of 2022. And this better than expected reading basically helped the DAX 40 recover this morning, and it looks as if we may bounce further, but we've got some resistance ahead now around the highs seen so far in April at 15,923, and these would basically, with a high from last week at 15,919, would need to be taken out for us to be heading back up again towards the psychological 16,000 mark. But from a technical perspective, what is important to watch now is today's intraday low and also the low from last week, so between 15,703 and 15,694, because if we were to fall through that area and close below it on a daily chart closing basis, we could then be not only heading down again towards the early February low at 15,656, but probably much lower and perhaps retest the 15,480 low seen earlier this month. So that's the important support area to look out for with regards to the DAX 40. Now, the picture is quite similar with regards to the Dow Jones Industrial Average. As you can see here, the daily financial bet has also declined, and yesterday's sharp decline, or sharper than previous decline, was on the back of First Republic Bank and its announcement that basically deposits had been withdrawn to the order of $100 billion in the first quarter, making that bank perhaps look less solid than it looked a few days ago, and that's why its share price dropped by up to 50% yesterday in the US before stabilizing somewhat. But it did have a negative impact on the Dow Jones Industrial Average. As you can see here, we're now approaching the March to April uptrend line, which can be seen at 33,400. So that's support to watch out for, as well as the 10th of April low at 33,332. So that's the important support that needs to hold for the bulls to be in control and for further upside to become possible. If we were to fall through that support area, though, we may retrace all the way back down again towards the late January low at 32,935. So that is a possibility. But I wouldn't be surprised if short-term we were to stabilize over the next few days with regards to equity indices, depending obviously on earnings, on future earnings that will be coming out from several companies with regards to their first quarter earnings in the US and in Europe in the next few days. The FX markets have also been quite interesting of late, with the US dollar recuperating some of its losses, which took it to a one-year low last week, but then being quite volatile over the last few days. And as we can see here on the daily financial bet of euro dollar, we can see the seesawing with regards to the euro dollar chart on the back of the weaker dollar or the stronger dollar as we saw since Monday. So a lot of zigzagging going on here on this daily financial bet, and it looks as if right now we are heading back up again towards the 14th of April high at 110.75, and if we were to rise above there, we could then be heading to levels last traded in March of 2022 at 111.85, and we also have here the red line, the 200-week simple moving average at 111.97, which represents an upside target for euro dollar. But what is interesting is that on the weekly chart we have been rising now consecutively for about 6 or 7 weeks, so euro dollar actually looking quite strong on the back of hawkish comments coming out of the European Central Bank, whilst the US since the beginning of this week has now a blackout period with regards to the Fed. So no more comments from Fed governors being seen in the US at the moment, and the European Central Bank looking far more hawkish than its US counterpart. Technically speaking, with regards to euro dollar, we will remain bullish as long as we stay above the last reaction low, that is to say Tuesday's low at 109.64 on a daily chart closing basis. Moving on to the British pound against the US dollar, you can see here that we also saw this seesawing on the back of the rising and falling US dollar, and you can see here I actually need to redraw my uptrend line because the data went through my trend line, which I don't want to see. So here now we've got the March to April support line coming in at today's low, basically around 124.03. And basically, as long as that holds together with yesterday's low at 123.87, further upside should take us back up again towards the highs seen so far in April at 125.46. That represents pretty good resistance, so it'll be interesting to see whether we'll fail once again in that area or whether we can actually break through there and head towards the 126 area. But as long as we stay above this support zone made up of the 10th of April and the mid-April lows going down towards 123.45, as long as we stay above there, further upside is more likely than downside. Moving on to the Australian dollar, we saw Australian inflation, year-on-year inflation drop to 7% from a previous reading of about 7.8%, and that has led to the Australian dollar sliding versus the US dollar. And you can see that here we've now fallen through an uptrend line going back to October of last year, and are heading down again towards the March low at 65.65. So that's the next downside target for the Australian dollar versus the US dollar. And we are trading, as you can see here, below the 200-day simply moving average in red at 67.40. And basically, as long as we stay below there, and the February to April downtrend line, which is slightly higher up at 67.52, as long as we stay below there, further downside is in store for the Australian dollar versus the US dollar. Commodity markets have also been affected by the zigzagging in the US dollar, slightly coming off when the US dollar rises, and vice versa when it falls. And when we look at the price of gold, we can see here that we're currently oscillating around the psychological $2,000 per troy ounce mark, and have been doing so for the last week or so. And basically, we've got some resistance coming in between $2,003, $2,009 short term today. Then we also have the high from last Thursday at $2,012. But basically, we are trading sideways between $2,012 on the upside and last week's low at $1,970 to the downside. Now, as long as we stay below $2,012 on a daily chart closing basis, I expect further sideways trading, perhaps with a small negative bias to be seen. And if that were to take us to below the 1,970 low seen last week, we would then likely be retesting the February high of $1,959, and perhaps slide also back towards the $1,944 mark, that is to say the late March low. Moving on to WTI, and the price of crude oil here, as we can see, has nearly closed all of the price gap with its late March high. And you might remember that we had this huge price gap on this chart because OPEC Plus basically announced a 1.16 million barrel per day output cut, and that led to this jump in the price of WTI, taking us all the way back up again towards $83.40, the April high. But then the red line here, the 200-day simply moving average, led to the price gap being at least partially closed. At the moment, it is still open between $76.48 on this daily financial bet, that is to say the low we saw yesterday, and the late March high at $75.76, as you can see here. And I wouldn't be surprised if we were to close that gap fully before then perhaps recovering again. Now, from a fundamental perspective, we are bouncing off slightly today, and that is on the back of industry reports showing that US crude oil inventories decreased by more than 6 million barrels last week, exceeding expectations for a 1.7 million barrel decline. But as the concerns about a slowing global economic growth and tightening financial conditions continue to hurt potential future demand, I expect the price of oil to continue to come off, and for us to perhaps close that price gap that I've just mentioned. So from a technical perspective, as long as we remain below this week's low, this week's high at $79.14 on a daily chart closing basis, we should see further downside, and we should retest the $75.76 high from late March, and could even retest the $72.64 to $72.50 area, which is made up of the January and February lows. So that is the technical view short term with regards to WTI. Now, I'd like to finish up on natural gas, and as you can see here, these are the natural gas futures in the US, and you can see that we have come a long way off last year's highs, then tried to rally on colder weather being forecast back at the beginning of March to just above the $3 mark, and then fell very close to the $2 mark. And as you can see here, the lows in February and April come in between $2.10 and $2.06. And since then, we've had also a minor bounce on another cold front approaching the US, and also European countries as we are seeing at the moment, the weather being relatively cold at the moment. But so far we've only risen to about $2.50, and since then have been trading sideways. And since the previous trend is still pointing down, I would expect a retest of last week's low at $2.28 to be seen, provided we stay below this month's high at $2.50. And if we were to fall through the $2.28 low seen last week, we would probably close that price gap we have had since the previous week, and could then retest the psychological $2 mark. So from a technical perspective, I expect further downside to be seen as long as we stay below this current month's high made last week at $2.50. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.